Hello, listeners. Before we get to the show, I'd like to tell you about an event that we're planning in Houston, Texas on July 9th. Ryan, you want to tell people about it?
Well, if you're a listener of the show, you know that me and Tate go buy real estate. Well, we are going to lift up the tent and show you all the details on how we find properties, select sites, conduct due diligence, and we're actually going to do a bus tour in Houston, Texas on Wednesday, July 9th from 12 to 4. And then after, we're going to have a happy hour at Tall Yard Brewing in Sugarland, Texas, which is just south of Houston at 4:30. And it's going to be a lot of fun. So you can come
Yeah.
meet other investors for a day of learning. We've set the time so that you can fly in and fly out same day from any coast or hub city. So I'm excited to invite our listeners, come meet me and Tate, come see us do property due diligence, learn about self-storage investing, learn about real estate investing, meet other investors. So I'm excited. But Tate, back to you.
It's going to be a lot of fun. You can come for the bus tour, you can come for the happy hour, you can come to both. We hope to see you there. Go to passiveincomepilots.com/Houston to RSVP.
Space is limited. See you soon.
Welcome back to Passive Income Pilots, everyone. Tait Duryea here with Ryan Gibson. What's up, Ryan?
Hey, Tate, I'm doing really great. Excited to kick off an episode and dive deep into an asset class that I'm in love with and have a lot of passion for doing today. So
Yeah.
I'm looking forward to today's episode. Yeah.
When people say commercial real estate, a big misconception is that they mean office. When you meet somebody who's just getting to know the commercial real estate side, they say, "Oh, you do office?" It's like, no, commercial real estate encompasses multifamily, obviously office as well. It could be medical office, could be actual office, mobile home parks, self storage, RV parks. You're talking about industrial. You're talking about what else? What am I missing here?
I think you pretty much covered it. But what I would say probably, an asset class that has grown up a lot in the last decade has been self storage. And it's really become part
Absolutely.
of the core food groups of commercial real estate.
Definitely.
And not a lot of people know a lot about it, and then there's a lot of misconceptions. Like I'll say, for starters, that people think that self storage has exploded in America because people have too much stuff, and that might be true. People might have too much stuff, but the reason why people use self storage might surprise you. And I think that it's an asset class that every investor should think about putting in their portfolio and at least learning about and being aware of.
I started investing in self storage passively almost a decade ago, actually, alongside Ryan, and got the opportunity. Gosh, was it 2021 that we got in a Cessna and we flew around to a portfolio of about 10 properties in the Southeast? I got some really great education all the way back then on the self storage asset class. And so while we are, fairly agnostic on this show about investing strategies and styles and asset classes, we thought, hey, who better to do a deep dive on self storage than your host right here, Ryan Gibson? So today we're going to be going deep into the self storage asset class to understand the economics behind it, the industry as a whole. And obviously, this will help build context around other asset classes within commercial real estate as well. So today, Ryan, let's dive in. Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll. Give us the history on self-storage. Where did this industry come from? If somebody's driving down the highway and they see this massive self-storage thing, like that didn't exist 50, 60, 70 years ago, right? What's the history around this asset class?
Yeah, the asset class has really been around for about 50 years. And so the first one starting in Texas in the early 1970s. And really it was just a covered land play, which is just a fancy way of saying somebody had excess land and they put up these storage units on it and they just boom, they filled up. And what's interesting is I actually had the opportunity to meet the guy that built the very first self-storage facility in the state of Washington in 1973. Chuck Barbo, who started SureGuard Storage, he went on to, create 650 self-storages. And it's so funny because, you hear about, this pioneer in the industry building these new self-storage facilities, and kind of the things that he thought about are the same things that we think about today. Like nothing in the industry has changed in 50 years, which is he thought, man, I built 16 of these in the Seattle area. We've probably built too much of this, And the industry has been saying the same thing for 50 years. So we have literally been always worried about overbuilding, oversaturation. And what's been so impressive about the industry is that these things just stay full. The last REIT report data that came out recently from CubeSmart, Extra Space, and Public Storage, which are the three largest operators or REITs publicly traded, are all reporting over 90% average occupancy, even at a time when self storage is actually kind of in a place where the demand might not be as good because of home sales being down. So,
Let's talk about why people use self-storage, and that'll tie into why maybe the demand is slightly soft in today's market.
I want to do two stories
Please.
about why people use self storage. So, the first story I have is I'm flying the 737 from Detroit down to Orlando, and it was COVID, right? So COVID hit, and you guys remember the airports cleared out. There wasn't anybody flying, and I had the 4-day trip that, for whatever reason, the whole board was canceled except my routes. So, we've all been through that, right? Why am I not getting sent home with pay? So I'm flying the 7-3 down to Orlando, and there's nobody on the airplane. Well, okay, there's one person. So one person comes on, one passenger comes on, and of course, the joke is like, "Welcome aboard your private 737 down to Orlando." And I had to go up to the passenger and just say, "Welcome aboard, and where are you going? That's so important right now. Like nobody's flying. We've been flying around empty literally all day." And she said, "Well, my mother-in-law just passed away, and I'm going to Orlando to move her stuff out of her home and into self storage." And so that kind of was a light bulb moment for me, because it was like, no matter what's going on in the world, shutdowns or not, this is an asset class that does really well. And actually, the asset class did exceptionally well during COVID, when America basically exploded into a big life event. People moved out of their houses to put their stuff in RVs. They moved stuff out of their home to make way for home office and for home gyms, and just rearrange their lives and put their stuff in self storage. And so the 4 Ds,
And moved.
yeah, they moved. Yeah.
The real estate market was going nuts. Everybody's moving. Sorry, and the 4 Ds.
Yeah, and so the 4 Ds, and really there's 5 Ds. So death, downsizing, displacement, and divorce. And the fifth one that I've kind of added into that is diapers. And I'll tell you one more story. When I was actually buying my house in Seattle, I bought a house because I had my daughter, and we were looking for a family home. And when we eventually moved out of that house because we were going to have a son, again, diapers, one of the 5 Ds, we ended up having to stage all of our stuff in a self-storage unit because we were selling one house and buying another. And I went, man, this is such a silly asset class. Like, I think self-storage is kind of stupid, right? But then it was like, wait, my real estate agent said, Ryan, you need to move all this stuff out of the house. You need to paint the house, stage the house, make it look really good so we can move this quickly for you. And so I didn't have my new house purchased yet, so I put myself in self-storage. And of course, it was in there way longer than I thought. And then when we moved into our new house, we got settled for about a year, and then we said, "Hey, we want to expand and renovate our house." So what do we have to do? We had to move ourselves into self-storage. And it was funny because I thought, well, we're just going to be there for 3 months. And of course, a year later, at 9 months in, the owner of this storage place raised my rents 20%. So I'm paying, now I'm in 20% sounds like a lot, but it was $20 a month on $100 unit. So I was like, what are you going to do? I'm not going to drive down there and move all my stuff out. So I was like, man, I got to get into this business because
Right.
this is a industry that has very sticky tenants. And in fact, our portfolio, we see about 36-month average stay across our portfolio, because people tend to move in and they tend not to move out. Yeah.
Which is way longer than multifamily.
Yeah.
The average tenancy in multifamily is about 16 months. And you talked about being sticky tenants. When you talk about raising rents on an apartment, and obviously if you renovate an apartment, that's a different story, right? You make it a lot nicer and you get maybe a 30 or 40% rent bump because now it's a much, much nicer unit. But what you're talking about is we call them ECRI, existing customer rate increase,
That's
right?
right. Yep. Yep.
And for the same box, you haven't improved anything, right? And you're increasing the rent. But when you look at an apartment rent going from $1,000 a month to $1,100 for the same unit, that's 10% versus 80 to 88. Like nobody wants to go borrow a pickup truck to move their stuff across town for $8 a month. It's just not worth their time, right? So those ECRIs can be very insidious and effective.
Yeah, and I think it's interesting. I always ask people, have you ever used, when I speak, it's like in present on self storage investing, I always ask people like, who here has used a self storage unit ever? And pretty much everybody's hand goes up because 1 in 9
Right.
Americans uses a self storage, and I think a lot of people think, another kind of like mystery here is that people think, oh well, I live in a rural area, I don't really need, but 66% of our customers have a garage. So to your point, Tate, like getting back to ECRIs, because I think that is an important part of it, is, everybody uses a self storage. So it's becoming very common practice. And it's a 30-day lease. And so some people think, oh, well, it's a 30-day lease. So that tenants are just going to move out after 30 days, or I got to go chase them around to re sign a lease every 30 days. No, you sign the 30 days. And all that really tells you is that you can adjust the rates every 30 days. So typically what we do and what the
Right.
industry does is people move in at a promo rate. You always see kind of that $1 move in special, or you get some kind of promotional rate. Then after a few months, you're going to get your rate increased. And so that's commonplace to sort of attract customers and then normalize the rates through an ECRI, which you can adjust the rates every 30 days. And that's a big part of our industry.
Let's talk about the difference between, who the customers are, because there's a common misconception that it's all just people with too much stuff. And it's actually not the case. And maybe also talk about a little bit of what happens if America finally gets their act together and gets rid of all that extra stuff, which
Well,
probably isn't going to happen, right?
the thing is America, we're innovators, we're movers and shakers, we're entrepreneurs, we're business owners. We aren't afraid to move away from our hometown and live in Florida and come back and see parents. And we're a nation of second homes, and we are a nation of traveling, right? So like we move around a lot and do a lot as a country, and those moves are what drive self-storage utilization, right? So even if we got rid of all of our stuff, even in my situation where I'm a pretty minimalist family, we still had to get a self-storage unit when we had a renovation at our home. And that's not going away. Until America stops moving and downsizing and relocating and job hopping and, you know, moving around the country like it has, there really is a future here. And it's become really popular now. It's gaining momentum in Europe and other parts of the world where the same sort of demographics are taking place, where people are moving and downsizing and relocate and things like that. So I don't think there's really a scenario where that is a case. It's interesting when you think about demographics. When I first got into the space over 10 years ago, baby boomers were our largest customer base. So if you look across the portfolio, baby boomers were by and large our best, our biggest customers. And the industry sort of held its breath in saying, will baby boomers still be our biggest, like, what will happen when they start to kind of move out and retire and phase out? Will millennials take their spot? And of course, you think of a millennial, you think of a minimalist. They like experiences, they like to travel, they don't like things, right? They're on the social media or whatever. They are our biggest customer segment now. And so what baby boomers use storage really differently than millennials. Baby boomers had heirlooms. I have a funny like Far Side cartoon where it's like, it's a storage locker stuffed to the brim of things, and it's a father telling a son, one day this will all be yours. And guess what? The millennial kids don't want your stuff. We don't want your hutch and your tea, China and all that, right? We don't want that, right? We just want we want to be minimalist to our point, right? And so now millennials are using self-storage in a way that's completely different. Housing costs are through the roof. Their apartment buildings are smaller. Affordability of home ownership is skyrocketing, right? So they can't afford bigger space. So they're using the self storage as an extension of their life for their life experiences, their motorcycles, their ski equipment, their snow tires, their outdoor gear, right? It's all going into a self storage locker because they don't have garages and extra space. So
Right.
they've taken over. And if you think about millennials, they're going through life events right now, right? They're having kids, they're changing jobs. Maybe they were at a place where they could work remotely. Now they have to go into the office. So that means they're moving, right? Like home sales are actually starting to pick up, and we're seeing a reversal of a lot of the rental increases. So it's really good. So millennials are picking that up, and I think that's just further emboldening our kind of our industry philosophy on life events, really kind of pushing moves in the industry.
Let's talk about business use.
Yeah, so I just described about 70% of our customer base as an industry, but 30% of our users are businesses. And this is a big part of storage because people are sheet metal contractors, landscaping companies, little league baseball teams. We have the Chamber of Commerce that rents from us in many markets, military institutions, education institutions, Amazon, Etsy businesses. All these staging companies are in there. Real estate agents are in there. Their signs and their posts and things like that. So, we opened up a store just south of Seattle, and the first 5 units that I rented was a furniture staging company that they were building 10,000 houses within a mile of our site. And they used the storage lockers to transact their staging equipment as they were buying and selling houses. They needed a place to harvest their storage, their staging equipment. So a lot of it is business use, and so we've really optimized a lot of our units to accommodate big trailers or landscaping companies, food distribution trucks that come in and out, they need like a place. And a lot of the HOAs across America, they restrict you from putting these vehicles in your driveway. So you can't
Right. You
have
can't put an RV
yeah, so
right out.
yeah, you
You can't park that outside your house.
exactly. So you can't have your contractor plumbing truck sitting in your driveway. You got to put it somewhere. I personally have a friend who is a food salesperson, and he can't put his truck in the driveway, so he drives every day to his storage unit, pulls out his food truck, swaps the cars, drives and does his work, and then he comes back at night and swaps it out. And so it's really become a big part of the industry as a whole. So
Let's also talk about, because you touched on something. It was the difference of millennials versus boomers, and the fact that the frequency of accessing those units is much higher with millennials because they're kind of using it as an extension of their garage. Baby boomers tend to put stuff in there, lock it up, don't see it for 5, 10 years. So there is opportunity to add value to facilities that have really antiquated access systems. Like, let's say they're only open from 9 to 5 on weekdays. That's not going to work for someone who wants to access their kayaks and bikes on the weekend.
yeah,
I just wanted to plug that in there because it's an important part when you're thinking about how these facilities are evolving over time to meet the customer needs.
no one really likes a kiosk, right? Let's be honest. They're kind of you walk into a Taco Bell right now or a fast food restaurant or a Panera Bread, and there's somebody standing at the counter, but it's like kind of not fun to like go manipulate the kiosk and kind of figure out how to use it. Sometimes this key stick or it's just too hard to kind of figure out, right? We actually revolutionized that. So our facilities that we manage, when you walk in, it's like a life-sized iPhone, a human-sized screen. And when you open the door, it actually 3, 2, 1 countdown, and then there's a real person on the screen in the facility. And to your point about like access and customer service, it's interesting what we're doing right now. We're actually blending having that customer service person on the screen with remote access to the property and being able to book units from afar and be more efficient. Because let's be honest, I mean, I've sat in a storage facility all day. You might see 2 or 3 people, maybe 4 people that actually come into the office. So we can manage multiple sites with that centralized
That's cool.
call person.
Right. And it's a real person. You're not talking to a computer, but
Yeah.
you're connecting with somebody on a big screen that's actually talking to you.
Yeah, so that's
That's
kinda cool,
cool.
and you've seen this maybe in the rental car company, but I would say automation now in the storage industry, that's now beyond what I just described. Automation is just table stakes in the industry now. Everybody's automated. There is no you when you go up, you should have a revenue management system. You pay your fee, you get your rent. You can do that over the phone or online with a QR code. And then as soon as you pay and have a bona fide lease and your ID is uploaded, you get a gate code and you can let yourself in to that property. And what happens is if you don't pay after 3 days, you lose your access to the facility until you pay up. And then, yeah,
And that's actually the next thing I want to talk about is, why did you focus in on self-storage? And this is one of the reasons, right? It's easy to evict.
yeah, it's easy to evict because we actually don't have evictions. We have auctions. And so when you look at a when you look at a self storage lease, the very first paragraph in a self storage lease says something like this: stored belongings is subject to lien in favor of the owner. So we can lien the belongings. So some people think, they see that, hey, Ryan, self storage is storage wars. Is that real? Right. That's about an annoying question as what route do you fly? because I get asked that question all the time. And it's kind of like the answer is like nothing what you think it would be,
Depends.
right?
Right.
You don't make any money in auctions as a storage operator. There is zero profit in auctions. You don't make any money. I can't say that enough. Nobody's making any money in self storage auctions. So let's say Tate, you're renting a unit from me for $500 a month, and you don't pay me for 2 months. So you owe me $1,000. And for whatever reason, you keep your Ferrari in there, and you can't keep up with your $500 a month payment. And so after 30 days, I can lien your belonging. I can lien your contents of your storage unit, and then I can auction it off to the highest bidder. And anybody can go on to selfstorageauctions.net, type in their zip code, and actually bid on local storage auctions. And you'll be grossly disappointed because you'll find that you don't even have to go. There's not an auctioneer that's standing there and making it dramatic. You can go online, and it's not a closed door and it's a mystery box. Literally, it's an open door. You can see exactly what's in the storage unit, so you can see that it's a Ferrari, and you can bid on it. And what happens is, let's say somebody bids $100,000 on Tate's Ferrari. Well, I only get $1,000 because that's all Tate owes me. Remember, that's a lien against his contents. Tate's going to get the $99,000 back from the sale of his auction, right? And I can cover any legal expenses or anything like that. That's like hundreds of dollars, right? We're not talking like big money. So I recoup my costs, but the bigger advantage to that auction is that I get my unit back, right? So Tate's out, he's not paying, he's delinquent. He gets his $99,000 for his Ferrari. Sucks for him because it's probably worth a lot more than that. I get my $1,000, but now I get my unit back and I can rent it out to a paying customer, and that's really valuable as a real estate operator to me.
Well, and that's insane because, and this is not to dog on multifamily. We love multifamily for a lot of different reasons. But if you're comparing it to self-storage in this respect, you look at a non-paying tenant, you're not going to recoup the money that they owe you. And they're going to leave and the unit's probably going to be trashed and it's going to cost you a bunch of money to fix the things that they damaged versus a storage unit, you sweep it out and it's on the market the next day.
Someone told me when I first got into the industry, they said, self storage is amazing because you can get the same rents per square foot as multifamily, but the build costs are a third and the operating costs
Yeah.
are a third. So you can literally get the same rents as a multifamily building at a third the cost. And so, you think about it, you build something in Houston, Texas, for example, you're going to get, $30 to $35 rents, depending on where you are for multifamily, get the same for self storage, but we're going to build for $90 to $100 a square foot, and multifamily is going to build for 300 to 400 a square foot. And so it
Right.
literally is just a third the cost and the risk, right? So when you think about how quickly it takes to lease up a storage unit versus multifamily and all the things all the people you have to pay for and things like that. Again, I'm a multifamily fan. I'm not saying I'm not dogging multifamily. I'm just comparing it. And I think that was a really good comparison that I was told early on in my investing career.
That's excellent. Let's talk about recession resistance. This is something that was a common phrase in the industry. I felt like 5 years ago, everybody was afraid of what was going to happen to their real estate in recession. It turns out that um, interest rates had, was kind of the thing that came out of left field. Nothing was safe from a 5.5% interest rate increase. So the recession talk didn't really ever materialize. But I think it's important to keep our eyes on that ball because, you know, when a recession hits, if you own a Class A, beautiful, expensive multifamily rental, um, your tenants are probably going to have trouble paying their rent when they lose their jobs. And so we like to participate in things like mobile home parks or B or yeah, B minus C plus class multifamily where people slide back into that when they have to lose a job, get on unemployment, maybe relocate. Self storage actually performs really well in these counter cycles, and I'd love to talk about that a little bit, and maybe why right now over the last couple of years self storage hasn't performed the best historically because there's been so much stability.
Yeah, couple things that I want to unpack. First of all, we all have our investment philosophies. I'm actually a believer in Class A all the time, and I've heard this B minus C plus thing where, well, if a tenant can't afford Class A, they're going to slide backwards into a B or a B minus, and we saw this in self storage too. And I used to be the buyer of B and B minus stuff, maybe C plus stuff, and try to move it up a half letter grade and things like that. But I actually am a firm believer in Class A now Because what happened in the last recession? What happened when someone couldn't pay their Class A property rent? Well, they left, or they moved backwards. So then what did the Class A property do? They lowered their rents to track their tenants and get and fill their vacancy. So now you can afford a Class A apartment building, and now it's harder, and now you got to lower your Class B and C because you can get an A for a great, discount. I
Yeah,
but it kind of zooming back out, I think that anybody who highly levers a floating rate loan is
absolutely.
going to
Yeah,
get wiped out when interest rates go from 0 to 5.5% in 6 months. So I
absolutely.
think a lot of folks didn't realize or didn't anticipate that large increase in interest rates. And so that made it strenuous on the expenses. At the same time, I think everybody kind of saw declining rents and a fight for occupancy. And that is what has dried up. Self storage has been lower leveraged. It's been a fixed rate because it's a commercial property. So there have been some floating rent, rates in self storage, but the way that it's been financed, I think, as an industry as a whole, has been a lot better. But also, we didn't really see the huge swings in occupancies and rates.
Right.
The ability to change rents every 30 days is a big deal because it allows you to sort of flex during inflationary times. It also allows you to flex during times where it's more difficult to attract a customer. And so I think it's kind of important to look back, rewind the clocks back to 2023 when the REITs got really aggressive trying to promote their storage units. And then they got very aggressive on when they raised their rents. And that's really what's contributed to their overall NOI growth. And the last thing I wanted to say, Tate, you asked about, how does this, how does this play into today? So let's talk about today where the moving is down. So if you look at the multifamily housing association, there's an 85% renewal rate in multifamily right now. It's the highest rate that they've ever had. So people are actually not moving out of multifamily.
And residential sales last year in 2024 were at the lowest level of transaction volume since 1993.
That's done two things to our
Yeah.
industry. That's actually stabilized our existing customers where they're staying longer and there's less churn at the property level, and it slowed down the move-in rate at the property. But the way that the industry has combated that, which shows its resilience. I mean, here's 25% of our customer base not transacting in storage because housing isn't moving as much and people aren't moving as much. But there's been NOI growth of 4% in the last 12 months in the latest REIT reporting. So when you look at what's actually happened, rent growth has been slow, but NOI growth, which matters, that's your bottom line, has actually been up because of the ability to raise rents on existing customers. So they're basically asking for more rent on customers, even though they have lower rates moving in. So it's funny. I saw somebody post about this. They're like, "Oh, did you know self storage rent is cheaper for new customers than it is for existing ones?" It's like, yeah, it's been that way for 50 years. Nothing has changed. There's been a bigger magnifying glass on it because a company like Extra Space maybe waited 7 or 8 months to raise your rents after you moved in, and now they're doing it in 3. And so this, tenants are going, customers are moving in and saying, "Wow, you gave me this $30 a month rate, and then at month 4 or month 5, you raised it to $150 a month. Like, what are you doing?" And you're like, "Well, yeah, that's the real rate." But now they're doing it months earlier and getting more money out of the customer. So it's actually a pretty resilient industry considering everything that happened. So when you look at, Credit IQ put out an overall distressed rates by property type, self storage literally has almost no delinquent loans in the industry. When you look at retail up at 11%, lodging up at 9%, office started at 3% and now is way above 10%. Multifamily delinquency is hovering between 3 and 5%. So the self-storage is zero, like literally zero for the last 3 years. There was a portfolio that went into foreclosure that kind of tainted the demographics, but as an industry, there has been very little distress because storage is kind of like a bond. It does well during good times and in bad because when Tate, you mentioned, hey, what happens when people move out of their Class A to their Class C, or they lose their home and stuff? People love their
Yeah.
stuff and they hold on to it and they'll
They,
put it into a storage
exactly.
unit, right?
Yeah, they got to put their TV and their couch into a storage room unit when they're going to go and they lost their jobs. They got to move in with family, and so that's what I mean by the fact that it performs well during those counter cycles. and it performs well during the upside because everybody's buying stuff.
Yeah, and I think that that's a good segue into kind of where the industry is at today because, extra space, if you look back 10 years, there's a lot of companies that used to exist that are gone. Life Storage is gone. SureGuard, for the most part, is only in Europe. They're gone. Uncle Bob's Self Storage. When you look at Simply Self Storage, all these big operators have been gobbled up by the big REITs, Public Storage, CubeSmart, and Extra Space. And so that's where we saw the opportunity 10 years ago was what can Spartan do to go buy assets from mom and pop operators and aggregate a portfolio? And what we found was that 70% of these storage facilities in America, there's only 60,000 of them, are owned by mom and pop operators. Most operators only own one property. And so they don't optimize it. And the one thing that we really take advantage of is a lot of mom and pop operators don't charge tenant insurance. So, and this is a big deal, right? The rental income and the things that we can do to raise rents, that's all great. But second to that is a tenant insurance.
Mhm.
So when we take over a 500 unit storage facility, a lot of times they don't charge tenant insurance. The mom and pop operator doesn't require it. And we can legally require every customer to have tenant insurance. And we sell the policy. So we'll come in and we'll say, hey, we're going to charge you $13 a month across 500 units. And we'll take 70% of the revenue of that and share 30% with the insurance company and add a million to million five in value just by charging insurance when the customer moves in. So it's a crazy industry. A lot of mom and pops that just built these properties years ago, and they're just happy that it's full, happy that they have a wait list, and they're not really optimizing it in the way that they can.
I want to get into industry consolidation and what that does to cap rates. But before we do, I want to dive into cap rates and NOI, and how commercial real estate is valued. If you've been listening to this show for a long time, you've probably heard us talk about this before, but I think this is a good segment to jump back into it. This is asset class agnostic. It doesn't matter whether you're doing industrial, multifamily, self storage, mobile home parks, whatever. If it's commercial real estate, it is going to trade on a multiple of value. If you're familiar with stocks, it's like a PE ratio, right? Price to earnings. So if a property makes X amount, the market determines what the multiple of that earning is, that someone is willing to pay for it. So Ryan, let's break down for the listeners what a cap rate is and how cap rate and net operating income come together to create what a property is worth.
If a property produces $100,000 a year in profit and you buy it for $1 million, you have a 10% cap rate. That's your capitalization rate. It's your cash flow based on the purchase price. Now that's your revenue less of your expenses. So your total net operating income. So if my property it costs me $200,000, if I bring in $200,000 of revenue and I have $100,000 of expenses and I make $100,000 and I paid $1 million, I paid a 10% capitalization rate. Reality is
There we
today
go.
you're paying about a 5% capitalization rate. So you're going to pay double that for the same income, right? So
So about $2 million for a property that produces $100,000 a year of pure, free and clear profit if you were to buy the property with 100% cash.
that's right.
So no debt, because debt brings in this variable where it's like your debt's different than my debt, and you put a different leverage ratio on it, so it muddies the waters. So cap rate and value is always determined on net operating income, and that is pre debt service payment.
That's right. That's how
So it
you
assumes
value.
you bought that property 100% cash. Sorry.
And that's how you value real estate. And so when I get excited about tenant insurance and I see that a mom and pop operator is not charging any, like the one we just purchased in Lincoln, Nebraska, the exciting part is, okay, I'm gonna get $10 a month out of 500 people, right?
Right.
So you're like, okay, well, what does that mean? Well, for every dollar that I increase NOI, it's $16 of value, right? So if you take the $1 and you divide it by a cap rate, 0.06, as
As at a 6% cap rate. If it's a 5% cap rate, it'd be
it'd be
20.
20, right?
Right.
So across the entire, number of units, so let's say there's 500 units, I'm increasing it by $10 a month. You divide that by, or you multiply that by 60. So, or I'm sorry, by 12. So $5,000 a month times 12, $60,000 a year of increases You divide that by a conservative 6% cap rate, that's $1 million of value. And that's why I get excited about, these mom and pop opportunities and being able to optimize. And that's just one piece of it, right? So maybe they didn't want to raise rents, maybe they didn't want to market, maybe they didn't want to push the envelope. They just like being full. So you can start optimizing by installing our kiosk, installing our screen, and doing automations and selling tenant insurance and things like that. So
Anything that you do to increase income or decrease expenses increases your bottom line. That's your NOI. That is what we as real estate investors have control over. So you have control over the performance of your property. What you don't have as much control over is the cap rate. Now you have some control because if you make the property really nice, then someone's going to be willing to pay a more compressed multiple for it. They're going to be willing to pay a premium, and that will reflect in a lower cap rate, meaning a higher value to the same income.
yeah.
However, cap rates generally float with market conditions and market dynamics. So, Ryan, let's unpack some things that change cap rates.
Yeah, so sometimes people usually cap rate is what it is, right? If you pay $1 million for that $100,000 of NOI, you paid a 10% cap rate. But remember, you got people that bid on the properties too, right? So somebody might be willing to pay a 4% cap rate for that property or a 5% cap rate, which is going to double the price. So when we say the market drives the cap rate, the market might be willing to pay as high as a 5% cap rate for that property. Maybe it's well located on a main road. Maybe it's in a market with exploding population growth. Maybe the property is pristine and looks great and has no deferred maintenance. Maybe it's in a market that has a lot of demand for self storage. Whatever it is, that's going to influence people bidding up the price. And that is going to drive down the capitalization rate. And that's what creates a market for cap rates. So people always tell me like, well, what are you guys paying for cap rates on your self storage properties? And I say, well, it depends on the property, but generally between 5.5% and 6.5%. And they say, well, geez, I've got a self storage facility that I'm looking at that's a 10 cap. And I'm like, well, where is it? And they're like, well, it's in the middle of nowhere. It's got 50 units and it's falling apart. And I'm like, well, my, my property is it's centrally located in a retail corridor next to a Costco, is 700 units, class A, not going to fall apart for the next 50 years, and has, a higher household income and higher rents, right? So I might be willing to pay a lower cap rate and a higher price because of the risk that comes with my property versus your jalopy in the middle of nowhere. So, it really just depends on a number of variables. And the one thing else I'll say about that is, what about how much payroll automation and expense load that is assumed going into that, right? Because like the devil's in the details. What is that operator assuming in their expenses and what are they demonstrating to you? In my properties, I have a full-time person. I'm going to assume some property tax increases and insurance. I'm going to assume that we're going to advertise and spend money on running a proper business. A jalopy, I'm going to use a jalopy example, far away in the middle of nowhere, they may be thinking, oh, there's going to be no employee here because you're going to run it, right? So now you just bought yourself a job. So that's why the cap rate is starting to become higher. They haven't assumed
Right.
any.
Property tax increase.
Exactly. So there's some
Yeah.
things that you really have to factor in when you're willing to pay a lower or higher cap rate.
There are also scenarios where cap rate doesn't make any sense. Take example, if you had that jalopy that was 100% vacant, there is no income.
Yeah.
There is no cash flow. There is no cap. It's
Yeah.
like it doesn't work, right? So it's like, okay, well, you willing to pay a 2% cap rate for this crappy property? It's like, well, it doesn't even, there's no connection here. So it has to make sense. There has to be a reasonable amount of NOI for the property. You get what I'm saying? So
One thing I wanted to more say about oh, go ahead, sir. One thing I wanted to say about cap rate too is here's a more extreme example, Tate. You buy raw land. It produces no income. So what cap rate did you pay
right.
for it? Well, the
Right.
way
So does
that
that mean it's worth
yeah,
zero? No.
no, it does not worth zero, right? Of course. And that's why I laugh, when people say, "Oh, but your home is not an investment." I'm like, because it doesn't produce income. But at the end of the day, like, well, what did you buy it for? What do you sell it for? There's income produced. It's no different than raw land. Like when you buy it and you sell it, there is no income produced until you sell. But here's the thing: there's measurements, right? So, for raw land like that, when you do build a self storage, there's something called yield on cost. So,
Right.
after I spend all the money building the property to get it to stabilized value, divide that by your total cost, your NOI divided by your total cost that went into it, that's your yield on cost. And you'll want something
Right.
like a 9 or 10% or greater yield on cost to show that, and then and you could expect that that property would trade for like a 5.5 or 6% cap rate when you sell it. That's where you create value, right? So
And essentially what Ryan is saying there is that you're building it for X and you're able to sell it for a lot more than it cost you
that's
to
right.
build it.
That's exactly right. Yep. So
I don't want to keep beating on cap rate, but let's just bring this full circle here. So we've talked about the fact that cap rates can float up and down depending on the market, but there's also things that affect it, like interest rates. So the higher the interest rate environment, the higher cap rates are going to be because it's going to cost you more to go to the bank and get debt.
yeah, so I think that's a great point. So when interest rates go up, historically, cap rates go up, but they haven't gone up.
Which means value goes down for the same amount of NOI.
That's right. But here's how resistant the industry has been to that. This is such a risk adjusted good investment that despite interest rates going up from 0 to 5, going up 5.5%, right? Down a little bit, but around 5%. Cap rates have only adjusted about 75 basis points, so 0.75. So imagine rates are supposed to kind of follow, cap rates are supposed to kind of follow the trajectory of interest rates. But if you think about how resilient real estate has been to that, real estate is still trading at a low cap rate and hasn't followed interest rates one for one. What that means though is that people are still willing to pay a high price for real estate, but it means your margins on your cash flow are going to be lower. So when you're
Right.
buying something that costs more to leverage at the same cap rate as it, at a lower rate, you're just going to see less cash on cash return. So we used to have deals that would cash flow 8 or 9% right away because the debt was 3.5 or 4%. Now we're buying deals for 6 or 7%, slightly higher cap rate. And the cash flow is now between 4 and 6% because the cap rate is still about the same, but the interest rate is higher. So your costs, your operating costs are higher. So the opportunity that I see, and I don't want to get into the crystal ball here, but we had we had Peter Limnum on last time, and he seemed to think long term. Turn the TV off, don't scare yourself. Long term interest rates are projected to fall. Short term, some bumpiness, right, with the markets responding to how this tax bill goes through and some other things, and how the bond market softens. But long-term rates go down, and that gives an opportunity to refinance potentially, and then cash flow better. And it also benefits you on the values going up. So I don't want to get into predictions,
That pushes down cap rates.
Yeah, but that's a
Absolutely.
dynamic between how interest rates and cap rates kind of play with each other. So
There's two more things I want to talk about that affect cap rates, and that is one. The second's going to be industry consolidation. The first one is one, capital flows, and the second is consolidation. So capital flows mean how much money is out there looking to be driven into a specific asset class or real estate in general. If everybody's trying to deploy capital into self storage, it'll push cap rates down and values up. We've seen a pullback over the last few years across all real estate asset classes. And so capital flows have slowed down. And that has obviously driven cap rates north, driven cap rates up and valuations down as interest rates have spiked and there's been a lot of turbulence in the market. So that's one. I just want people to be aware
and
that capital flows obviously affect cap rate.
yeah, and I want to talk about that because
Yeah.
in our industry of self-storage, the REITs have not been buying as much the last 2 years. And for a couple
Right.
reasons. One, their stock price has been generally somewhat down, and they've had to buy off their balance sheet if they buy something. So they're only going after something super attractive. And two, they've been dealing with a lot of M&A. Life Storage was acquired by Extra Space, and Simply Self Storage was acquired by Public. That was the Life Storage Extra Space merger was a $13 billion merger. So they were consuming a lot, and so they were kind of pencils down in a lot of buys for a while. And so without that REIT pressure where are coming in at a low cost of capital to buy a lot of properties, that created this massive opportunity. So we actually
Right.
took advantage of that where we were buying properties, self-storage facilities for a very high cap rate that would have otherwise traded sub 4, sub 5%. We were getting at 6.75 or even a 7% cap rate. And these are main high quality facilities. And then we were having the REITs actually continue to manage them. And now that the REITs are projected to start,
For anybody that's confused on
yeah,
that, REITs also do third-party property management on a contract basis, just
yeah.
to throw that out
And
there.
I think that's important to talk about because, these REITs, it's not like multifamily is a very the third party property managers are kind of all over the place. There isn't like one central REIT that really dominates multifamily. Maybe Graystar, but self storage is really limited to three big players. You guys have seen the orange doors, Public Storage, green door, or the wasabi green, the extra space, and the red doors, CubeSmart. That's pretty much it. And if you're going to self storage, you're going to Google public storage probably or whatever you Google, and that's going to bring you to a public storage site. So they really dominate the marketing. It's like Kleenex. Like Kleenex is public storage or
Yeah.
extra space, right? So those are,
Well,
yeah,
that brings me to my last point on cap rate, and I promise I'm done after that, is industry consolidation. So when you have a really fragmented market in some, left field asset class, it's going to trade at much higher cap rates. You show me like you said, the jalopy facility that's out in the middle of nowhere. You're going to trade at an even higher cap rate if it's not self storage, if it's some wacky off the wall thing that produces income, but it's not in the vertical. And when you have a lot of industry fragmentation and mom and pop operators, those assets are going to trade at higher cap rates. And as industry consolidation rolls and rolls and rolls, and there become fewer and fewer mom and pop operators, those cap rates start getting compressed because it becomes a more efficient market.
and the first properties to sell in that market are Class A self storages. Like in the self storage industry, the first ones that are going to trade for a low cap rate are the highest quality assets in the best markets. So when we
Right.
start to think about what we're buying today in storage, we want the nicer stuff that's better located in markets that REITs will want to buy, right? Your 10 cap in middle of nowhere is going to get a 10 cap in middle of nowhere buyer, right? You're going to take a long, and trust me, I know I bought properties in the middle of nowhere and they are impossible to sell. And so that's what real estate takes, right? You got to have enough buyers to pay the price that your facility has, and you need to find a lender, right? So finding a
Right.
buyer, finding a lender, those are the two things that make your real estate usually work, or your financing. So it's important to, if you're going to get industry consolidation, you need to have things that the big institutional players want. And so that's a trend that we've seen, is buying these more well located facilities.
Excellent. Well, speaking of well located facilities, if you've ever wanted to come down and actually see these things in action, see them in person, walk the facilities, we've talked a lot about the things that we consider when we're looking at investments. If you want to go and see it in person, you're going to have that opportunity. Ryan, you want to talk about our Houston tour coming up in 3 weeks, July 9th?
Yep. So we are actually we're partnering and buying 7 properties, Tate and I, in the Houston market. And we're going to show you exactly what we look for: the demographics, the location, the due diligence. And we're going to take a bus tour. We're going to go from site to site. We're going to have a lot of fun. We're going to play some games. We're going to network. We're going to drink. We're going to do whatever. We're going to go to each site. And we're actually going to walk the site and learn about self storage as an industry. We're going to learn. We're going to go into the actual buildings that we're buying, and we're going to talk about with the due diligence that we go through on these asset classes. And we're going to talk about what makes a good market, what makes a good location. We're going to look at the asset quality and kind of do like a little micro due diligence walkthrough of these properties. And we're going to host our listeners on it. Now it's limited because we only have so many seats on the bus, quite literally, right? It's about a CRJ's worth
Yeah,
of people that we can take. But so register for the jump seat early, get to the gate, right? Do your thing. So if you want to sign
that's
up
right.
for that, Tate, we're doing this Wednesday, July 9th. If you want to sign up for that, Tate, how do we do that?
Go to passiveincomepilots.com/Houston. That will redirect you to a Google form. You'll be able to RSVP there. It's going to be a lot of fun. You're going to be able to meet other investors. We're super excited to meet some more of our listeners. Our happy hour in Peachtree City was a massive success. Had a ton of people come out, so we really appreciate that. This one's going to be a little bit more interactive. Things kick off at noon on Wednesday, July 9th, in Champion Forest. We'll have the bus there. We're going to go to a couple of locations, and then that will dump us out on a happy hour at Tall Yard Brewing in Sugarland, which is just south of Houston. The bus will then continue back to the airport for anybody that wants to fly in and fly out. But you could stay for a few beers and then Uber to the airport as well. We'd love to have you there. So check out the link, and we hope to see
Yeah,
you.
and Tate and I actually like we checked all the flight schedules, right? So like
We
as
did. We did.
from C-
Yeah, we made sure that you can get from
yeah,
LA,
yep.
you can get from San Francisco, you can get from Atlanta, you can get from New York, and it's possible to get there by noon for this kickoff.
Yep, so you can come in, come out, you don't have to spend another layover or buy a hotel room, so that was kind of the goal. And if you wanna stay for the happy hour, if your flight allows you to do that, that'll be at 4:30, and we can kick it. So, really look forward to seeing everybody, on that tour and talking more about this awesome industry that we're in and seeing a real deal that you can invest in potentially. So, pretty excited about it.
Yeah. PassiveIncomePilots.com/Houston. Check it out.